I've been staring at this terminal for, it has to be 3 hours now, just watching the tape, and I keep waiting for the other shoe to drop. Because what we are seeing right now, this morning specifically, regarding the relationship between the bond market and the metals desk, it's not just an anomaly, it's a violation of the rules. If you open up a standard correlation chart, go back 5 years, go back 10 years, the math is usually incredibly simple. It's almost mechanical. When the US 10-year yield spikes, and we are talking about a violent move here, up 11 basis points in essentially 48 hours, pushing right up against that 4.28% level, when that happens, silver is supposed to die. That is the trade. That has been the trade for a generation. High rates kill zero-yield assets. A stronger dollar sitting there at 97.50 makes the metal expensive for the rest of the world. The algorithms see the yield go up, they sell the silver futures. It's automatic. But look at the price. Silver isn't collapsing. It's not even really flinching. We had that washout earlier in the week, sure, that panic flush down into the 70s that cleared out the weak hands. But right now, as the yields are ripping higher, silver is sitting there at $88, $89, just absorbing it. It's refusing to break. And that is the mystery that actually worries me. Because when an asset stops reacting to the primary bearish catalyst, when the thing that is supposed to crush it hits it squarely in the face and the price doesn't move, it tells you that the seller is exhausted. It tells you that the algorithms are firing sell orders, but something or someone on the physical side is stepping in and swallowing that liquidity whole. This isn't just strength. Strength is when you go up on good news. This is divergence. And in my experience, specifically looking at how these commercial banks position their short books, divergence is usually the precursor to a breakage. If the price won't go down on bad news, the only direction left is a violent move up. But here is the problem. The open interest, the amount of paper bets stacked against silver right now, is positioned for a crash. They are positioned for yields to do exactly what they are doing. They are betting on the correlation holding. If silver doesn't roll over here, if it holds this $86 to $90 range while yields stay elevated, we aren't just looking at a rally, we are looking at a mechanical failure of the short side. I want to walk you through exactly what I'm seeing in the order flow, because there is a number, it's not the price, it's a ratio that flashed red this morning, and it suggests that the panic isn't happening in the gold or silver pits. The panic is happening in the offices of the people who owe that metal. Let's dig into this. You have to put yourself in the shoes of a portfolio manager running a macro book right now. Let's say you're sitting in London or New York, and your mandate is to hedge against rate sensitivity. You look at the screen on Monday, and you see the setup. It's perfect. It's textbook. You have Kevin Warsh getting the nod for the Fed chair spot. Markets interpret that as hawkish, disciplined, maybe a bit tighter on liquidity than the previous regime. What happens? The bond market reacts instantly. The curve sells off. Yields spike. We saw the US 10-year Treasury yield rip 11 basis points higher in effectively 2 sessions. 11 basis points doesn't sound like much to a retail trader, but in the bond market, that is a violent repricing. It pushes the yield up to 4.28%, a level we haven't really been comfortable with for 5 months. At the same time, the dollar index, the DXY, catches a bid and grinds up to 97.50. So, if you are that fund manager, the trade is obvious. You short precious metals. It's the easiest trade on the board. You sell silver futures because mathematically, silver has a carrying cost and pays 0 interest. When I can get 4.28% risk-free from Uncle Sam, why would I hold a volatile metal that costs money to store? You sell it. You press to short. And frankly, looking at the commitment of traders data coming into this week, that is exactly what the speculative funds did. They piled in. They saw the rates moving, they anticipated the crush, and they sold. But this is where it stops making sense. Usually, when you get a macro signal that clear, yields up, dollar up, the correlation coefficient is -1. Rates go up, silver goes down. It's almost 1-to-1. But look at the last 48 hours. The yield spike hit the market, the sell orders hit the tape, and silver just sat there. It hovered. It dipped, sure, we saw that volatility where it tested the lower bounds, maybe flushed some stops near the low 80s, but it didn't break. It's trading right now between $86 and $90. That is the contradiction. That is the signal that should be keeping the shorts awake tonight. Because when you throw the kitchen sink at a market, when you hit it with the exact macro conditions designed to destroy it, and it refuses to go down, that tells you the selling pressure is purely superficial. It's paper selling, it's algorithmic selling. But underneath that, there is a bid that is so thick, so relentless, that it is absorbing every single contract the shorts are throwing at it. And I want to be precise about who is misreading this. It's not the retail crowd. The retail crowd is mostly just confused by the volatility. The people misreading this are the systematic funds, the CTAs, the trend-following algos. They are programmed to chase the yield correlation. They see rates up, they short silver. They don't look at physical wallet withdrawals. They don't look at the premium on Shanghai coins. They just look at the 10-year. And right now, they are trapped. They are shorting into a wall. This brings me to the specific data point that I think explains the why. It's not on the COMEX feed. You have to look at the physical premiums in the East. While the paper price in New York is struggling to figure out if it should be $85 or $90, the physical market in India is screaming. We are hearing reports, and these are fairly reliable, coming from the import desks in Mumbai and Gujarat, that the crash we saw earlier this week, that dropped to the 70s, was treated as a massive clearance sale. The demand wasn't scared off by the volatility, it was triggered by it. You have Indian silver rates holding firm, practically decoupling from the international spot price when you factor in the import duty and the local premiums. We're hearing numbers like 2.8 lakh per kilogram being the floor in the physical bazaar. Think about what that means. The paper market in New York is trying to push the price down because yields are up, but the physical market in India is essentially saying, thank you, we'll take it all. This disconnect between the West, which trades paper derivatives based on interest rates, and the East, which buys physical metal based on value, is the widest I have seen since the squeeze back in the early 2020s. But this time, the volume is higher. The sheer tonnage moving from west to east is staggering, and the shorts in New York are blind to it because it doesn't show up on a Bloomberg terminal until the registered inventory reports update, and by then it's usually too late. Now, in a minute, I want to talk about the mechanism of how this squeeze actually triggers, because it's not just about buying, it's about liquidity drying up. But before we get there, you need to understand the scale of the exposure here. When I say the shorts are trapped, I don't use that word lightly. I mean that mathematically they are shorting an asset that has run out of sellers. To drive the price lower from here, from this $88 level, you need new sellers. You need people who own physical silver to panic and sell it. But who owns the physical silver at these levels? It's not the weak hands. The weak hands sold at $75 during the panic. The people holding silver at $90 are the believers. They are the strategic reserves. They are the industrial users who need it for solar panels and electronics and are terrified of a shortage. They aren't going to sell just because the 10-year yield went up 11 basis points. So the shorts are selling to each other, or they are selling to the banks who are hedging, but they aren't finding real liquidity. And every time the price ticks up, even 50 cents, the pressure on those short positions compounds. I was looking at the volatility index for silver, VXSLV, and it's doing something strange too. Usually when prices stabilize, volatility drops. The market calms down, but volatility is staying elevated. It's elevated because the market knows this isn't over. The market knows that this flat line we are seeing, this refusal to break, isn't peace. It's tension. It's a coiled spring. The narrative you are hearing on the mainstream financial news, if they cover silver at all, is that higher for longer interest rates are bad for metals. They will show you the chart of the DXY at 97.50 and say, see, dollar strong, gold and silver weak. That is the lazy analysis. That is the analysis that gets you run over, because they are ignoring the debt component. And this is the part that really starts to undermine the whole bearish thesis. Why are yields rising? Is it because the economy is so strong that the Fed has to cool it down? Maybe a little, but a big part of that yield spike is the market starting to choke on the supply of treasuries. It's a sovereign debt issue. When yields rise because investors are demanding a higher premium to hold U.S. debt, that is not bearish for precious metals. That is bullish. It's the ultimate validator of the debasement trade. So you have this perverse situation where the very thing that the algos think is bad for silver, rising yields, is actually signaling the exact crisis that silver protects against, debt spiral. The algos are selling the signal, but the smart money is buying the noise.
And that is why the price won't drop. The market is sniffing out a regime change. It's realizing that the 10-year yield at 4.3% isn't a sign of strength. It's a sign of fiscal instability. And in a world of fiscal instability, you don't want dollars. You don't want bonds. You want the thing that has no counterparty risk. I want to pause on that specifically. Counterparty risk, because normally we think of risk in terms of price dropping. But the risk facing the shorts right now isn't just price, it's delivery. If you look at the eligible versus registered stocks on the COMEX, and I know people obsess over these charts and sometimes read too much into them, but the trend is undeniable. The registered category, the stuff that is actually available to be delivered against a futures contract, is thin. It's historically thin. So when you have a paper market that is leveraged hundreds of times over the physical inventory, and then you have a divergence where the paper price refuses to drop despite the macro headwinds, you have to ask yourself, are we approaching the delivery wall? This is where most people get trapped. They see the price down from the highs. Remember, we were higher not long ago. And they think, oh, the trend is broken. It's a bear market. They look at the daily chart and see a mess, but they aren't looking at the structure. The structure is saying that the selling energy has been fully absorbed. The bear raid failed. Think about the psychology of a failed raid. If you are a bear and you expended all your ammunition, you used the Fed news, you used the yield spike, you used the strong dollar, and you only managed to knock the price down for 2 days before it stabilized, you are naked, you are exposed, and the market smells it. This is the setup. We have a trapped short base, a physical market that is draining inventory, and a macro signal, yields, that is being misinterpreted by the machines. But here's the catch. Just because the setup is bullish doesn't mean it goes straight up. In fact, the mechanism of how this resolves is usually much more painful than a simple rally. It involves a flush that nobody expects, or a grind that bores everyone to death before the explosion. In the next part, I want to break down exactly how this mechanism works, because there is a behavioral signal I'm seeing, specifically in how the options market is pricing tail risk, that suggests the big players are positioning for something violent, and it's not what the headline numbers suggest. So let's talk about the mechanism, because identifying a divergence is one thing, saying, hey, price should be lower, but it's not, but understanding how that resolves into a price move is where you actually make or lose money. The mechanism we're looking at here isn't a standard supply and demand auction, it's a liquidity vacuum. When you have a market that is heavily shorted by systematic funds, these are the guys trading billions based on the 10-year yield chart, they're operating on margin. They're not selling silver they own, they're selling promises. And as long as the price stays below their entry point, they're fine. They're in the money. They feel like geniuses. But the moment the price ticks against them, the moment silver reclaims a level like $93 or $96, the math flips on them instantly. It's not a linear loss. It becomes exponential because of the volatility. Here's the behavioral signal that most people are missing right now. I was looking at the option skew this morning. Usually, when a market crashes like silver did earlier this week, everyone buys puts. They want protection. They are terrified of the price going to zero. But if you look at the premiums today, the calls, the bets on higher prices are getting bid up. Why? Because the smart money isn't afraid of a crash anymore. They are terrified of missing the rip.
They know that if this yield trap breaks, if the market realizes that higher yields don't matter for silver anymore, the move up won't be a gentle drift. It will be a gap. The price will essentially teleport from 88 to 95 and then to 100 plus because there are no sellers in between. The sellers are the ones who are short, and they will be scrambling to become buyers. This is the short squeeze dynamic, but it's more subtle than the game stuff you see on the news. This is structural. It's about the COMEX delivery mechanism. If those shorts are forced to cover and there is no physical metal being offered at these prices because India bought it all, the price has to go to a level that induces someone to sell. And I promise you, nobody is induced to sell their physical stack at $88. Not in this geopolitical climate. You have to look at the exhaustion level. We saw the volume spike on the sell-off, and now volume is drying up on the consolidation. That is classic exhaustion. The bears punch themselves out. Now, I want to stop for a second and do something that very few analysts like to do. I want to tell you exactly how I could be wrong. Because if you are sitting there thinking this is a guaranteed winning lottery ticket, you are going to get hurt. There's a scenario that invalidates this entire thesis, and you need to watch for it. If the US 10-year yield doesn't just stop at 4.28% or 4.30%, if it unhinges and rips to 4.5% or 5.0% in a disorderly fashion, that changes the game. At that point, we aren't talking about inflation or strong economy. We're talking about a liquidity crisis, a deflationary shock. In that scenario, nothing is safe. When the bond market truly breaks, funds sell everything to raise cash. They sell gold, they sell silver, they sell Bitcoin, they sell stocks. It's a margin call on the world. If we see the DXY spike to 105 or 110 rapidly, silver will crash. It won't matter that the physical market is tight. The paper market will liquidate and we could see $60 again. I don't think that is the likely path. The Fed knows the system can't handle 5% yield right now, but it is the risk. If you are leveraged to the hilt expecting a moonshot and we get a liquidity event, you will be wiped out before the recovery happens. That is the danger. It's not that silver isn't valuable, it's that the mechanism of the market can stay irrational longer than you can stay solvent. But assuming we don't get that total systemic cardiac arrest, assuming we stay in this high tension zone where yields are annoying but not catastrophic, we're looking at two very specific paths forward from here. Path A is the frustration grind. This is what the banks want. They want to keep silver pinned in this 85 to 90 range for weeks. They want to bore you to death. They want the retail traders to get impatient and sell their positions to chase tech stocks or crypto. This allows the commercial banks to slowly unwind their short positions without spiking the price. They cover quietly, day by day, eating up the liquidity without triggering the alarms. If we see the price chopping sideways for another 2 weeks, that is actually incredibly bullish long term because it means the base is building. Path B is the snap. This happens if a catalyst hits. Maybe a geopolitical escalation, maybe a weak jobs number that crushes yields overnight. If silver breaks that $96 ceiling with volume, the shorts panic immediately. There is no slow covering, it's a stampede. And this brings us to the climax of the setup, because right now, as I speak, we are sitting exactly on the fulcrum. The price is hovering at a level that's uncomfortable for the bulls because it's not going up yet, and terrifying for the bears because it's not going down. We are about to see which side blinks first. And there is one specific indicator, a scenario tree really, that I am using to decide when to act. It involves watching how the price reacts to the next piece of bad news. So let's map that out. So here is the playbook, and I want to be very clear. This is not advice. This is a battle plan. Because when you are dealing with a market that's dislocated, where the price on the screen doesn't match the reality in the vault, you cannot trade off emotion. You have to trade off levels. I am looking at a very specific decision tree for the next 72 hours. Scenario A is what I call the fake out flush. We might see one more attempt by the shorts to break the spirit of the bulls. They might use a piece of news, maybe a hawkish Fed comment, maybe a slight bump in the DXY to push silver down to test that $84 or $85 zone again. If that happens and you see the price dip but the volume is weak, that is the trap. That is them fishing for stop losses. If we touch those lows and instantly wick back up, that is your confirmation that the floor is solid. That is the buying opportunity for the physical accumulator. It means the India bid is still there waiting to catch falling knives. Scenario B is the breakout. This is the one everyone wants, but it's also the most dangerous to trade. If silver pushes through $93 and then takes out 96, the FOMO, the fear of missing out, is going to kick in hard. You'll see headlines everywhere. Silver squeezes back. Retail money will flood in. If that happens, I'm doing exactly the opposite of the crowd. I'm not chasing that first green candle. I'm waiting, because in a high volatility environment, breakouts often fail the first time. The price spikes, hits a pocket limit sell orders, and collapses back down. I want to see a breakout, a close above the level, and then a retest. I want to see the old resistance become new support. That is the only safe entry in a market this rigged. And then there is scenario C. The scenario we talked about earlier, the failure. If yields blow out past 4.35% and the dollar rips higher, and silver closes below $82 on heavy volume, then the thesis is wrong. The divergence was temporary. The macro gravity won. In that case, you have to respect the price. You cut the risk. You don't argue with the tape. You step back and wait for the dust to settle. There is no honor in holding a bag because you know the fundamentals are right. The market can remain irrational until you are liquidated. So what am I watching? What is the one thing that determines which path we take? It's the 10-year yield, but specifically, it's how the bond market closes the week. If yields finish the week at these highs or higher, and silver is still standing, that is the victory. That is the signal that the bond vigilantes have lost their power over the metal. What am I not doing? I am not using leverage here. I know the temptation is high. I know the options market is screaming 10x returns, but the volatility is pricing that in. If you are wrong on the timing by 2 days, you lose everything. This is a spot market game right now. It's a game of possession. He who holds the metal wins. He who holds the contract pays the premium. And finally, what would change my stance? What would make me flip bearish? Sudden inventory injections. If I wake up tomorrow and see that 20 million ounces of silver have suddenly appeared in the COMEX registered vaults, if the warehouses are suddenly flooded with metal that wasn't there yesterday, that changes the math. It would mean that there is hidden supply somewhere, maybe unreported stockpiles, maybe sovereign selling, that is coming to market to cap the price. If I see that, I am out. But right now, the trend is the opposite. The trend is the drain. We are watching a slow motion bank run on a physical asset. It doesn't happen all at once. It happens gradually, then suddenly. We are in the gradual phase, but the sudden phase is blinking on the dashboard. This brings me to the question I want you to answer in the comments. And don't give me the easy answer. Think about it. If the paper price of silver drops to $60 tomorrow, but the physical premiums in India and China double, which price is real? Are you trusting the casino in New York or the bazaar in Mumbai? Because right now, those two worlds are divorcing, and you have to decide which settlement layer you believe in. I'm going to be watching the repo market very closely over the next few days. There is some weird data coming out regarding shadow banking collateral that usually precedes a major liquidity event. It's complicated and it's boring to most people, but it's usually the smoking gun. If I see what I think I'm seeing there, we aren't just talking about a silver squeeze next time. We're talking about a collateral shortage that forces the Fed's hand. I'll pull those charts for the next one. Stay safe.